The scene at the port of Long Beach is stark. Towering cranes, usually in constant motion, stand idle against the California sky. Ships, laden with goods from across the Pacific, are anchored offshore, forming a mournful queue. These vessels represent billions of dollars in commerce, now stalled. The usual hum of activity, the roar of trucks, the shouts of workers, has been replaced by an unsettling quiet. This quiet is not peace, it is the sound of economic disruption. It is a visual testament to a trade war's lingering painful effects. The air is thick with frustration and a sense of deep unease among those whose livelihoods depend on this vital gateway. This is not a new problem, but its persistence is alarming. For months, even with a supposed truce in the US-China trade war, the chaos has continued. It is a complex knot of logistical nightmares, economic anxieties, and human consequences. The ripple effects spread far beyond these port gates, touching businesses and consumers across the nation. The port, a symbol of global connection, now illustrates a painful disconnection. The urgency is palpable. Business owners wonder how much longer they can absorb the instability. Workers fear for their jobs, their futures clouded by uncertainty. Earlier this year, a glimmer of hope appeared on the horizon. The United States and China agreed to a 90-day pause in their escalating trade war. This truce, which commenced on February 1, 2025, and concluded on April 30, 2025, was met with cautious optimism. The intention was clear: to provide a window for negotiation, to de-escalate tensions, and to prevent further economic damage. Tariffs that were set to increase were put on hold. Businesses, battered by months of uncertainty and rising costs, breathed a collective tentative sigh of relief. The hope was that this 90-day period would allow supply chains to stabilize and for some semblance of predictability to return to international trade. However, the pause itself was fraught with complexities. 90 days is a short time to resolve deep-seated disagreements on issues like intellectual property theft, forced technology transfer, and trade imbalances. While negotiators met, the underlying uncertainty persisted. Businesses were hesitant to make long-term plans based on a temporary reprieve. The truce created a pause in tariff hikes, but not a pause in anxiety. The numbers paint a grim picture at the port of Long Beach. Following the conclusion of the 90-day trade truce, the anticipated rebound in cargo volumes has simply not occurred. Instead, port authorities report a significant drop in 20-foot equivalent units processed compared to pre-trade war levels. For May 2025, early data suggests a continued slump, with import volumes down by as much as 15% year over year. This isn't just a minor fluctuation, it's a clear indicator of deep-seated problems. Cancelled sailings, known in the industry as blank sailings, have become increasingly common. Shipping lines, facing reduced demand and ongoing uncertainty, are choosing to skip port calls or consolidate services. The statistical downturn is not just an abstract economic indicator, it translates directly into reduced operational capacity and heightened anxiety for the entire maritime logistics sector. The silence of the cranes and the emptiness of some docks are statistical realities bearing witness to a trade environment still very much in turmoil. The primary reason for the continued turmoil at the Port of Long Beach is pervasive uncertainty. Retailers and manufacturers are caught in a difficult bind. The 90-day pause did not result in a long-term trade agreement. The threat of new or reinstated tariffs looms large. Businesses struggle to make critical decisions about inventory and pricing. Do they order goods now and risk tariffs if policies shift, or delay orders and risk stock shortages if demand picks up? This guessing game is paralyzing. Many retailers had engaged in front-loading, creating surges at ports. The truce period was too short to break this cycle. Companies couldn't confidently resume normal ordering patterns. The ongoing chaos at the Port of Long Beach, exacerbated by the trade war's unpredictable nature, carries a significant human cost. Thousands of jobs are directly and indirectly tied to the port's activity. When shipment volumes decline and operations slow, it's the workers who feel the immediate impact. Longshoremen who load and unload the massive container ships face reduced hours and fewer work calls. Frank, a longshoreman with 15 years of experience at the port, told us, "It's feast or famine. One month we're working overtime, the next we're struggling to get enough shifts to make ends meet. The uncertainty is the worst part. We can't plan our lives. Truck drivers, vital for moving goods from the port to warehouses and distribution centers, are also hit hard. Lines of trucks waiting for cargo that is slow to arrive or process mean lost time and lost income for drivers, many of whom are independent owner-operators. Maria, a truck driver who has hauled containers from Long Beach for a decade, explained, "Fuel costs are up and now the wait times are unpredictable. Sometimes I wait hours for a single load. If the cargo isn't moving, we're not earning. My income has dropped nearly 30% this past year. Some of my friends have had to sell their rigs." Fluctuating tariffs and supply chain disruptions have trickled down to American consumers. The 90-day truce provided a temporary halt, but previous levies and ongoing uncertainty still affect prices. Retailers face a tough choice: absorb increased costs or pass them on to consumers. Many do both, leading to higher prices for everyday items. Prices for furniture, electronics, apparel, and groceries have noticeably increased. Tariffs have undeniably contributed to inflation. U.S. tariffs on Chinese goods have cost American consumers billions. Sticky pricing means consumers don't see immediate relief. Small businesses struggle to navigate this challenging environment. The chaos at the Port of Long Beach and the struggles of retailers and consumers are symptomatic of broader economic tremors rippling across the nation. The U.S.-China trade war, despite any temporary pauses, has injected a significant dose of uncertainty into the U.S. economy, impacting investment, growth, and inflation. Economists point out that trade policy instability acts as a drag on business investment. When companies are unsure about future tariff levels or market access, they postpone expansion plans, delay hiring, and hold back on capital expenditures. This hesitancy can slow down overall economic growth. Dr. Emily Blanchard, a trade economist at Dartmouth College, commented, "The 90-day truce was a political signal, but it didn't resolve the fundamental economic uncertainties. Businesses thrive on predictability. The ongoing trade tensions mean that the cost of doing business remains elevated, and the risk of further disruptions is always present. This can shave percentage points off GDP growth over time." The 90-day pause in the US-China trade war was like hitting a brief pause button on a very tangled movie. When you press play again, the knots are still there. Global supply chains are incredibly complex, finely tuned systems. They involve a vast network of manufacturers, suppliers, shipping lines, ports, railways, and trucking companies. The trade war introduced massive disruptions, forcing abrupt changes in these established flows. Companies rushed orders to beat tariff deadlines, creating surges, or they held back orders, creating lulls. This bullwhip effect sent shockwaves up and down the supply chain, and a short truce was insufficient to smooth out these deep-seated distortions. One major issue is that the underlying infrastructure and operational challenges at ports like Long Beach were not addressed by the tariff pause. Issues such as chassis shortages, drayage inefficiencies, limited warehouse space near ports, and labor deployment rigidities predated the trade war, but were severely exacerbated by it. Looking ahead, the future of global trade, particularly US-China trade relations, remains highly uncertain. The recent 90-day pause, while a brief respite, did not fundamentally alter the trajectory of these complex dynamics. The Port of Long Beach's ongoing struggles serve as a potent reminder that the path forward is fraught with challenges. What happens next depends heavily on diplomatic efforts, domestic policy choices in both nations, and the strategic decisions made by businesses worldwide. Will we see a return to escalating tariffs, or can a more stable, predictable trading environment be forged? The answers are far from clear. One potential outcome is a prolonged period of managed trade, where governments continue to play a significant role in shaping trade flows through tariffs, subsidies, and regulatory measures. This could lead to a more fragmented global economy, with distinct trading blocs and more resilient but potentially less efficient regional supply chains. Businesses may accelerate efforts to diversify their operations, reducing reliance on any single country, a trend already underway. This de-risking strategy, while prudent from a business continuity perspective, could also lead to higher costs for consumers and slower innovation as global collaboration is curtailed. The implications for the global economy are significant.